It's been a long time that I posted a video on my channel, but today we're going to be looking at IFRS 16 leases, but that will be sales and leaseback. If you go to my channel, you're going to find an initial video that I made about leases, the features of finance lease, how to determine the present value of a lease, the fair value of a lease, how to establish an implicit rate of interest in a lease, depreciation, how to determine lease liabilities at the end of the year, and the interest component that goes to the statement of profit or loss. But we are going to be looking at the concept of sales and leaseback. And I have done this very topic and illustration before, but I need to update one of the slides. And in order to do that, I've just decided to do this video all over. I've taken the other one down. But for you to be able to follow what I'm going to be doing properly, what I recommend is that the first comment on this video contains the question, and the second comment is the slide that I'm using. So if you have this downloaded to your system, it will be easier for you to follow. But when we talk about sales and leaseback, companies enter into sales and leaseback transaction because they want to free up cash flow. A company might have an immediate project to execute, but because they are tight on cash flow and probably unable to get it from the bank or unwilling to borrow it or issue a debt instrument, what they might do is take up one of their assets that they can sell to a buyer, then they will now lease that asset back from the person. So for instance, if I have an asset that if I sell it, I'll be able to generate 8 million pounds, and I am in need of, let's say, 7.5 or 8 million pounds, and I sell that asset, I can lease it back maybe for 500,000 pounds. So if I sell it for 8 million and I receive the cash and I lease it back for 500,000 for 1 year, that means that I have 7.5 million immediately to be able to invest in an alternative courses for the business. So this would be the main reason why companies go into sales and leaseback. There might be other times where they are just trying to do window dressing. We're going to talk about that as we progress. But now, at the end of this lesson, these are the objectives that we hope you should achieve. Sorry. You should be able to assess whether when a transfer between the person we call the seller lessee to a buyer lessor qualifies as a sale. Number two, what will be the accounting treatment when a lease transfer qualifies as a sale? Number three, what will be the accounting treatment when a lease transfer doesn't qualify as a sale? And then what will be the journal entries for a sales and leaseback transaction? So, if a sales and leaseback qualifies as a sale, now what this means in essence is there are some times where, because companies are unwilling to declare the full extent of their liabilities, they can transfer an asset that is worth, let's say, 3 million pounds. They transfer it to a buyer lessor and they receive 8 million pounds. So if the fair value of this asset is 3 million and they're receiving 8 million, in essence, what is happening is that they have received about 5 million more than the value of the asset. So they are taking a loan in pretext of selling an asset. Once this happens, Sometimes we want to say that this transfer doesn't qualify as a sale. That is like a second reason. But the main or the first reason why we will say a transfer does not qualify as a sale is that the risk and reward associated with the asset still remains with the seller lessee. So if we want to check if a transfer qualifies as a sale, we use IFRS 15 as a guide that will say we determine the contract implicit in the transfer, we determine the performance obligation, and then we ask ourselves, at the date of transfer, have we handed over the control of this asset to the buyer, or do we still have control over the asset? If we still have control over the asset, then it doesn't qualify as a sale. Now, the secondary reason which I gave first is also when you borrow money, but instead of making it explicit, you do it discreetly because you sort of want to hide your liability. But these are the steps to determine if a transfer qualifies as a sale or not. We are going to be looking at the contracts in the steps to determine a sales transaction in IFRS 15 after our next video on sales and leaseback. If the transfer of an asset from the seller lessee to a buyer lessor qualifies as a sale, the first two steps that you take is number one, de-recognize the assets from your own books, this is from the books of the seller lessee, and record a profit or loss on disposal. Then number two, you record the lease liability by recognizing the right of use and the liability associated with this lease. What this means is that if you've sold it, check if you made a profit or loss on the disposal. Then number two, since you are leasing it back, recognize two things: the right of use, which is like the cost of the asset under a lease transaction, and number two, the liability associated with this new lease agreement that you've entered into. And these two steps will require you doing three things. Number one, if you are recording the right of use of the asset, how do you measure the right of use? It is measured at the proportion of the previous carrying amount of the asset that was transferred. So you ask yourself, what is the proportion of the carrying amount of the asset transfer that I still retain as the seller? Let's say I'm going to show you how to do that. Number two, you record the lease liability, the present value of the future lease payable, all the amount of money that you need to pay to fulfill this lease obligation that are left unpaid at the beginning of this contract. You record the present value of that lease liability as the lease that the liability that is associated with this lease. And then number three, you recognize a proportion of the profit that you made on this lease transfer, which is the proportion of the profit recognized would be associated with the portion of the right of use that was transferred, the carrying value rather that was transferred. So I'm going to show you how to go about this. Then we look at accounting treatment if a transfer of a lease does not qualify as a sale. The seller lessee, if it does not qualify as a sale because the control of the asset still retains with you, that is the benefits associated with the asset and the risk associated with the asset still reside with you. When do we say this happen? If you still dictate how the asset is to be put to use, if you still maintain the asset in terms of repairs, if you pay for things like the insurance associated with the asset, that means that you are still the owner of the asset. It's not been transferred. Therefore, you continue to recognize the asset in your statement of financial position, and the proceeds of sales and leaseback should be treated as a financial liability, applying the requirements of IFRS 9 financial instrument. So the money you got in this lease contract or year will be treated as if a financial liability in line with IFRS 9. Now, by now you would have downloaded the question on Benito, which is in the first comment. These are the key information in that question. Number one, we are told that the fair value of the asset that Benito transferred is 6.75 million. The carrying value of that asset is 3.75 million, and the cash received is 7.5. There was something that I said earlier when I was saying if an asset is 3 million, for instance, and you sold it for 8 million, the excess 5 million will be treated as a loan. So if you look at what we have in Benito question, we know that the fair value of the asset is 6.75, but the cash received is 7.5. This means that they have received 0.75 higher than the fair value of the asset. So in essence, what we want to do is that we're going to treat this 0.75 as additional financing, which should be financial liability. Then we look at the present value of the lease payment. The question told us that the present value of the lease is 5.74. But because we understand that within that amount, 0.75 shouldn't be classified as a lease liability, it means that we're going to say 5.47 less 0.75, and that gives us 4.72 as the actual lease PV of the lease payments or PV of the lease payable. Then we did say that if a transfer qualifies as a sale, what we do is that we de-recognize the asset, then we recognize a profit or loss on disposal, and then we recognize the right of use of the lease and the lease liability. And we did say that the right of use is recognized as a proportion of the carrying value of the rights retained by the seller lessee. So the easiest way of doing that, there are a lot of ways that many authors present it, but I have a way of doing it. So the first thing is to ask yourself, what is the right of use percentage? The right of use percentage is the actual present value of the lease liability divided by the fair value of the asset multiplied by 100. So the PV of lease liability is 4.72. Remember, you cannot use 5.47 because that one had 0.75 embedded in it. So we use 4.72 divided by the fair value multiplied by 100. So that is 0.6999. So that gives us 70% approximately. So the right of use to be recognized, right of use percentage is 70%. Then we multiply it by the carrying value of the asset that was transferred to the buyer lessor, and that gives us 2.62. Then the percentage, the portion of the profit for us to recognize, we're not going to recognize the entire 3 million profit. How did I get the 3 million? The carrying value of the fair value of the asset was 6.75 and the carrying value is 3.75. Therefore, the profit from this sale is 3 million in total. but the portion of the profit I'll recognize is associated with a portion of the right transfer to the buyer lessor. So if the present value of, if the right of use of the asset is 70%, it means that the portion of the right transferred is 30%. Always work it out as a difference. So if I had 50% here, the portion of the profit I recognize is 40%. In this place, if I have 55, I'll recognize profit of 45, and so on and so forth. So the total profit is 3 million, but the profit to recognize is 30% of the 3 million, and that is 0.990. Then what would be the journal entries? Number one, I received the cash of 7.5 million. So I'm going to debit my cash and bank account with 7.5. The right of use of the asset, which is like the cost of the leased asset, is 2.62, which we calculated as 70% of the carrying value of the asset. Then, because I have sold this asset, I'll de-recognize the asset because this qualified as a lease, and I'll de-recognize the asset and credit my property, plant, and equipment with 3.75. That's the carrying value of the asset. And then if you look at this next line, I'm saying lease and financial liability. I could do it in two ways. Number one, I'll say lease liability 4.72 and financial liability 0.75. The two of them will give me 5.47. So I didn't say lease liability, I said lease and financial liability. So I added the two amounts together to show that the PV of the lease is 4.72 and the additional financing is 0.75. So the gain on right transferred is 0.90. So if you add the two sides, they are going to be equal. So that brings us to the end of this question on Benito. My next um my next topic that I'm going to treat is still sales and leaseback, but that is going to include where there is asset modification. And immediately after that, we're going to be looking at expected credit losses. To get an update on the treatment of leases, the basic concept, you're going to find them on other videos on this page. So thank you so much for uh listening. See you in the next video.